Good morning, everyone. Welcome to our funding seminar, the last one for 2018. Today we're going to talk about funding for your business and how we may be able to help you understand what it is you need to grow your business. Now, before I get started, I just want to give a little bit of a background on my team. So MSI Action Group is a continuation of a company that I started in 1990. This company in its current form was set up in 2009, and we focus on doing everything from business planning and projections for companies to helping companies source funding, to teaching their team to be more effective within the workplace, helping businesses to put into place systems and policies and procedures, and helping them to strategically grow their businesses. On the other end of the spectrum, we also help businesses to be sold or transitioned or succession planning happening to either people within the same organization or people that are interested in buying that company and carrying it on. So there's lots of things that we do. But today we're going to focus on funding, because without funding and cash flow in an organization, it's very difficult to grow your business. So we're going to talk about things like funding options that are available. I'm going to talk in quite a bit of detail today about what you need for information. And I'm going to delve a little bit deeper than we have in past seminars into what it is that the organization is looking for in that information. And some of the stuff that are gotchas that we've noticed as we roll out of 2018 into 2019. So then we're going to talk about a little bit about how to proceed to get to where you want to go and next steps. So some of the things you need to think about before you get started. The more you're ready beforehand, the better you are at the better probability of you being successful. So of all of you that are on the call today, I'd like to ask you, where do you start? Oh, I see. Someone says planning, another person said with an idea, another person has indicated with some clients. Yes, in different respects and different regards, you're all correct. The main thing is to start to figure out what you need to do to be successful, and how do you go about it? So before I talk any further, I'm going to play this little snippet for you from the BDC. It talks about what banks look for when they are helping businesses to grow.
As an entrepreneur, you want your company to prosper and grow. So you will likely need to find financing for your business. But the idea of meeting with a bank might make you nervous. Understanding how banks think will help you feel more confident and improve your chances of getting a loan. Bankers are business people too. They need to assess whether your project is an acceptable risk for them, and if you will be able to repay your loan. Their risk evaluation will not only determine whether you can get a loan, but also what the interest rate and conditions will be. You should have a detailed business plan because it is your job to make it easy for the bank to lend you money. It should present your business opportunity, backed up with statistics, market studies, and reports. It should also introduce your team and clearly outline your plans for the future while avoiding jargon or too many technical details. Overall, your business plan should address the factors they will be evaluating. Before meeting with the bank, be sure to check your personal and business credit scores. Ensure your comments reflect what's recorded there, and have the basic documentation you'll need to apply, such as your financial statements. Show them you're willing to put your own money into your business. This shows your commitment, financial stability, and willingness to share risk with the bank. So, what exactly do banks look for? Well, they will evaluate your project itself. Will it contribute to the profitable growth of your company in the years to come? They will also look at the ability of your business to repay a loan by analyzing the following indicators: the financial strength of your business, including the cash flow it generates, and the state of your personal finances. Assets. Do you have assets to secure the loan, meaning assets the bank can seize and use to repay itself in the case of default? Your management credibility, including background, past experience, education, and the professional training of you and your management team. And finally, they'll carefully analyze your industry, the economy, and the competition. Basically, banks are looking to reduce the risk of lending your business some money. The better you present yourself, and the more solid your business plan is, the better your chances of getting your loan approved, and you getting the money you need to grow your business and succeed.
There we go. So let's carry on. Okay, so the next thing I want to talk about are what are the initial things that I see over the years that help or hinder you from getting funding. One is not having a business plan. So not having a story and a laid out, thought out plan for what you're trying to do with the business. Now these come in different formats, and depending on the type of funding you're looking for, you can provide a format or a plan in a different level of detail. But all in all, the bank wants to see you have a business plan with financial projections, with funding requirements laid out so that you can move things forward. The second one that I see as a barrier is people walk into the bank asking for money and they're not prepared. They don't have all the information they need. They don't understand what their current situation is. They don't have everything prepared that they think the bank might need or the funding group might need. And so they look like they're not prepared and organized business owners. And the last one, which is also really critical, is not having the right help, not having the right people in your corner, whether they're accountants or lawyers or business consultants like us, in your corner to help you be successful with whatever you are trying to do. So success for funding comes from being completely transparent. So I've had a lot of situations where people don't want to share information with the banks, or they don't want to share information with the funding group, so they don't want to share information with us. And the trouble is we don't want to find out all the information at the same time as the funding group. For example, let's say you had a bankruptcy in the past 7 years. We need to know that before we go in to talk to a funding group. Or you've had a bankruptcy in 10 years ago. We need to know that it's been dismissed and that you are completely free and clear of that bankruptcy. We need to also understand things like your credit and things like that. So you need to be completely transparent about things that might have happened in your life in the past that we need to be able to explain or mitigate in the future. We also need to make sure that we're fully prepared. Everything that we have on a list that we have developed, and make sure that they have what they need and with the right help. So making sure that everyone that you work with is in your corner, that everything's up to date, they understand what you're trying to do. The types of funding that are available. So this is a high-level list of the funding that's available. So there are your typical banks, the big four, the big banks in Canada: RBC, CIBC, National Bank, TD Bank, Royal Bank, Bank of Montreal. Those are the big ones. Then we have another layer of banks called that are called credit unions. So credit unions are a little bit looser mandates than the major banks. They're banks like First Calgary and Bow Valley, and then there's other ones like Service, there's Tangerine Online. They all have an affiliation though with another bank. We have the BDC, which is a government mandated bank borrowing specifically for businesses. We have private lenders, we have investors that want to invest in your business, we have grants, we have the Canadian, Alberta, and job training grants, and the same grant is in every province across the country. And then we have alternative funding, which can be factoring, it can be asset-based lending, it can be lending for equipment, it can be inventory lending, it can be an operating line for big projects, it could be all sorts of different things. I know some companies that do AR and AP management for companies, all sorts of different flavors. So there's also the loans versus the grants. So I want to ask a question. How many of you know the difference between loans and grants? Let me see. Let me take a poll. How many of you know what a loan is? Excellent. Everyone seems to have that under control. How many of you understand what grants are? No, not so many people. Okay, so loans are typically money that you ask for from either a bank or a lending organization that you have to pay back and pay an interest rate on with a set repayment structure and usually terms of payment. So 30 days, 5 years, 10 years, 15 years, with an interest rate associated with it. Grants typically are not repaid, but they must be used for the purpose that they were granted for. And normally there's a reporting and accountability requirement with them. The other thing that I want to mention on grants is there's usually a percentage of a grant that you must put in the game as well. And those can vary from nothing at all, if they decide to grant the whole amount, to about 10 to 25% of the funding. And some of them even get up to 50%. So they want you to put skin in the game as well. So if you think you're going to go and apply for a grant and they're going to foot the entire bill, that is not going to happen. The third one that is sort of a mix, which is a mixture of a loan structure and maybe an equity structure, are investors. So investors or private lenders can potentially put in money for a percentage return or a percentage of equity plus repayment in your company. Oh, sorry about that. So this is a list of the main information that the banks and the funding organizations and the grants will look for. If your company is more than 2 years old, they're going to look for year-end financials that are properly prepared by a CA or a CPA in today's terms. If you don't know if the person that's creating your financials is a CPA, I strongly recommend that you ask them directly if they are a CPA. If they're not, you might want to look for someone who can oversee the preparation of your year-end financials who is a CPA. The banks put a lot more trust in year-end financials if they're prepared by a CPA. And there's different levels of financials that they may require depending on the risk of the company. The business plan, they want a business plan in place. Some of them can be a high level, like an executive overview, and some will want to see a full business plan. We actually recommend that you take the time to do a full business plan. It shows them that you're thinking out 5, 10 plus years into the future with your business, as well as a list of the funding usage that you want the funds for, and a 3 to 5 year projection, including the ability to repay the funds if they are not grants. The next one is your credit score. So we've had a lot of fun with credit scores recently, partly because of the tough times that people have gone through. What we ask everyone that we work with is you print your credit score in detail, and you can do that from any of the main credit facilities. I had someone the other day use Credit Karma. we don't usually use that one, but Equifax and TransUnion are the ones that we typically recommend. Print it for yourself and any of your business partners and your spouses. Because if you are an owner of a company and the banks or the funding groups decide that your family history, credit history also plays a part, they may ask for the history of your partners as well. So make sure at least everyone who's ownership in the company, pull their credit score and look at it. Make sure that all of the credit facilities on that credit report are yours. And if there's things on there that aren't yours, we need to take measures to get rid of them. So I can tell you that this happens a lot more than people think. We've seen people put credit cards on other people's credit scores that they have never even had. We had one person where a credit card was created in Quebec for an Alberta person, and that person reneged on their payments on the credit card, and that credit card the bank actually deemed it as fraudulent. So they're in the process right now of removing it from that person's credit score. When they do that, her credit report is going to rebound. We've seen other ones where they've intermingled two people with almost exactly the same name onto the same credit report, so you have to fight to get those things off, because when you get those things off, your credit report your credit rating will increase, and that increases your probability of being able to get funding. So make sure you print it off. I also recommend that people have Credit Watch, so that you can get a credit score or a credit report on a regular basis, and it monitors your credit and makes sure that nothing is happening that you aren't aware of. The next thing on the list here is the notice of assessments, both for the company and for you personally. And they usually recommend 2 years. And what they're looking for with the notice of assessments is that you have been paying your taxes, both personally and business, and your taxes are up to date. You're not carrying a massive balance, and that you are being accountable to the government for your taxes. If for whatever reason you owe money, what they're also going to ask for is what is the payment plan for that payment. So as long as you have that in place and you're not just running away from paying your taxes, that helps us to work with the banks or the funding people. They're also going to likely ask you for year-to-date financials. So if you're in the middle of a business year, they're probably going to ask you for year-to-date financials, a list of payables and receivables, project projections, signed contracts with clients, bank statements, and many other things and you need to be willing to provide those, and not documents that have been manipulated. I've had people provide an AR report and they black out all the client names. There's 2 things they're looking for on a receivable report. One is that you actually have clients. The second one is, who are they? And are they recognizable companies that the bank can relate to for good, solid clients? The next thing they're going to ask you for that's really important is your net worth statement. So you might want to keep one up to date for yourself and your spouse. So all the owners in the company and the spouses of the owners in the company. Keep net worth statements up to date, so it's easy for you to provide a net worth statement in whatever format they request. And why they're doing that is they want to see that you have other equity and other wealth that you have in your life, and that you, if need be, have the ability to support what you're asking the banks for. Now, depending on what you're asking for, your personal net worth may or may not come into play, but they want to see that the owners actually have net worth outside the company. So that could be properties, it could be any number of things. Oops, I did that again. The next thing they are going to look for is that you are actually set up as a real business entity. So the real business entity is, just one moment, just bear with me for a second. I just have to help someone get connected to the seminar. Okay, sorry about that. I just had a text from someone. So the next thing that they're going to probably is the business entity. So they want to see that you are set up to be a business, not self-employed, not a self-contractor, not someone that's a sole proprietor. They would prefer, now sole proprietors, they might help if you have employees. They would rather see you set up as a real business entity. And the real business entities are partnerships, corporations, LLPs. They can be profit or nonprofit. They can be charities, but they want to see that you're set up with the proper business structure. They might ask you for your GST numbers and your payroll numbers and your business entity numbers. They want to see that you are actually operating as a business when you're asking for business funding. It also helps to limit your risk personally and keeps your business at arm's length from your personal wealth. The lenders may also ask for other information. You just need to be willing to be transparent and go with the flow. Sometimes they may ask for the same information 3 or 4 times. You need to be patient. I get people that are really upset and they get really frustrated when the funding group asks for more information. They're doing that to assess you as a client. And if you want the business funding to grow the business, and you know the impact of that funding is going to be very important to the business, you need to be patient and willing to grow the business in the right direction. They may ask you for things like personal T4s. They may ask you for T5s as business owners. The T4s they will not include anything that has to do with EI. So if your entire T4 is based on you getting EI, then they're not going to want to do any of the funding. If you're currently working for another person and you decide to start your own business, we strongly recommend that you do not, I stress, do not stop working for that other company until you have fully acquired the funding you need. You can't get funding if you have no sources of income. It's not going to happen. Okay, so one of the things when they're looking at your financials is the debt ratio. And I only put this up as an example. You don't need to worry about trying to make it happen. This is the most common one they look at. They want to make sure that you can service the debts. They look at the equity in the company, they look at the debt in the company, and they want to see that you can service the debt in the company. So it's quite straightforward. It's quite simple. This is just one of many ratios they will look at, and your accountant should be able to help us assess the debt to equity formulas. All right. So the next thing that we're going to go into is a little bit more detail on all the different types of funding, and then I'll open it up for some discussion before we wrap up the webinar. So the first group that we're going to talk about are banks, and everyone knows about the banks. Everyone has bank accounts at the banks, but I'm just going to go through some of the stuff that you may or may not know about a bank. So the first one is they provide loans based on your credit history, your personal net worth, and your year-end financials. So they are basing it on you. And until a company's making multi-millions of dollars, they will continue to look at you as the owners of the company and whether you are a strong owner and business owner of the company. The next one that they talk about is small loans. So some of the branch managers can handle small loans. I believe their limit right now in most banks is up to $250,000. If there's loans bigger than that, Then you're moving into the commercial banking layer of the banks, and those people can do much different. They look much different than the small business bankers. The commercial bankers can do a lot different type of funding, and they have a lot more latitude to set up a lot different types of loan or funding structures for you as a business owner. The banks, the major banks, are also being held responsible by the government to run the federal government Canadian Small Business Financing Program. This is a small business program that's help for expansion or startup of small business, and they can look at things like assets or equipment purchases or building and leasehold improvement funding. So if you want to go with that, we would help you do that through a business bank. The next is they can provide lines of credit. They can provide credit cards. One of the credit cards that I like is a credit card that is also associated with a business line of credit. CIBC calls it a biz line. Scotiabank, I believe, calls it Scotia line, I think they call it, but it's a lower interest rate than a normal credit card, and it allows you to use it as a credit card or a line of credit, so it's quite handy. The next one on here is that there are lots of different types, lots of different flavors. Community Futures is a rural Alberta bank, and they are a bank of last resort. So if you've gone through your bank and your bank won't do the funding you need, Community Futures or AFSC may step in and help you. BDC provides loans based on your credit history, your personal net worth, and your year-end financials. So again, they're looking at you as the owner of the company and whether you are a good risk for them to lend to. Now, there's two different layers, or there's multiple layers of the BDC, not just two. The first layer is the BDC Virtual Business Center, where you can apply online for a quick $100,000 loan, and that loan is totally based on your year-end financials and you as a business owner and your credit history. You can get those loans in about 4 to 5 days if everything aligns properly. Small business loans are up to $250,000. They have a lower interest rate and they're flexible terms. So a lot of the business loans from the BDC will be interest only for the first 6 months, and then you start paying the principal and interest back. The larger loans for startup and restructuring projects will be obviously greater than the $250,000, and some of them are industry specific. Some are for women only, some are for acquisitions, some are for equipment, some are for Aboriginals only, some are in the tech space, some are manufacturing. They're all over the place. So when we talk to the BDC, we try to align you with the right business loan model that works for your business. And sometimes they'll do inventory funding for you. Private lenders and private equity people, private investors, I'm going to talk about them probably together because they're very similar. So what they're doing is they're providing loans to your business based on your credit history, your personal net worth, your business plan, and your projections. Now, on the lender side, they're looking for a percentage return on their money and a set period of time. If they're a lender / investor, they may be looking for a return on their money and on a payback schedule, as well as a percentage equity in your business. So there's some things to think about and be careful of. One is that you want to make sure you don't lose control of the business. So if you offer up a percentage equity in your business, make sure it's less than you have. So it's less than 51%. So it's less than 49, so you own 51 at the most. What we are finding too with all the scams and the shysters out there is that you also need to do the same verification on them as they do on you. So we have now implemented an approach where we actually will ask them for government issued identification, both for their company and for themselves. And we will request either a face-to-face meeting or a video call. So we can verify their identity and they are who they say they are. Sorry, so that person's still having trouble getting on. Just hold on one second. Let me just see if I can help them get on. Sorry about that. So investors are very similar. Usually they will want a return on their money for a set period of time. They may want a return on their money every year. They might wait 3 years and then ask for to start drawing back the equity that they put in the company. And they can be individuals or they can be groups. So there's very flexibility. But when you go into the private investor and private lender space, you must know what you're doing. So grants, tax credits, and subsidies, there's thousands of grants out there, both from government organizations and private foundations and associations. The grant processes for each one of them is different. The success factors for the grants are different. If they agree to fund, there will be criteria around that you must adhere to while you're working with them. The grants can be by industry, they can be by business, they can be for startups, women, hiring immigrants, hiring Aboriginals, special needs, all sorts of things. Some are tax credits, so you get reimbursed after the year is done for the work that the tax credit covers. For example, there is a green tax credit. There's also research and development tax credits that are given back to you after the fact. And then there's subsidies. Subsidies are there to help you hire workers, and they will help support some of the hiring costs of that subsidy, or of that employee, sorry. The job training grants. The job training grants are a special type of grant that are associated with helping employers train and develop their teams. It is for employees of a company. So it means they have to be employed by your company, not subcontractors. They have to be employed by a company as an employee, and you must be paying EI on their paychecks. The employees must be Canadian citizens, permanent residents, or they can fall into the special refugee categories as well. It covers 2/3 of the training costs for the training, and 2/3 of the repayment at the end of the training. So they'll give you, so basically the company ends up paying 1/3 of the training cost, and in the end, the government covers 2/3 of the cost. Now, the company must pay all the training costs up front, and then they get reimbursed. And that's important for people to understand. The whole amount for the training has to be paid up front, and then you can recoup it back. And there's a lot of banks, once you have a training grant approved, that will give you the funds to pay for the training, and then they'll let you recoup it if necessary. So with this grant, it means that per year, per employee, you can recoup up to $10,000 of the training, which means you can have each employee trained for $15,000. $10,000 will be covered by the government, $5,000 by the company. This grant will cover up to 30 employees per company per year, and you can submit for the training grants year after year after year. They say that the training has to be completed within the 52 weeks. And the week cycle for this grant goes from April to April every year. The training needs to be 24 hours of training minimum. It has to be a training group that is a third-party training group. It cannot be training that is done within the company. So the trainers that come in to do the training have to be third-party training companies. They can come in and do all sorts of different types of training. Workshops, one-to-one training, team training, strategic planning. The owners of the company and their immediate families and anyone on the board of directors is exempt from the training grant. It doesn't mean they can't take the training, you just can't submit them for the grant. And they expect it to be that you are a business entity. Now they have added some exceptions for sole proprietors who have employees, but the main training is done by the grant. So the next thing we're going to talk about, and this is getting close to the end, is the alternative funding. So the lease, there's lots of different types of funding. One is the lease to own. One is factoring. So there's different terminology for factoring. So factoring means that you're taking a project PO or a receivable, and you are going to a factoring company, and you are I'm just going to mute that mic. And you are getting them to give you a percentage of funds that you can use while the receivable comes in. It's a good way to get a temporary coverage for funding while you're working on large projects or long-term projects. The other terminology for factoring that seems to be more palatable for people are companies that will partner with you, and they'll do receivable and payable management. They will release the funds to you that are equivalent to the receivables while they process the receivables. So it's like a type of factoring. A lot of big companies that do big projects will use receivable factoring. It's very standard in the industry because companies need to be able to pay their payroll and their vendor expenses while they're waiting for the receivable to come in the door. The next one on the list is asset-based lending. Asset-based lending is used when you are looking for funding and you have enough large assets in the company that you can lend against. It's almost like lending against your mortgage in your house or getting an equity line in your house, except you're lending against assets in the business. And again, it's to free up money to use for cash flow and cash management in the business. Purchase order financing is used to fund projects that you actually received a PO for. So for example, let's say you had a big project, it was $1 million project, and you have a PO from the client. You can actually go to a lender in this alternative funding area and ask them to give you financing or money leveraged against the PO. And in most cases, it allows you to float the payroll and the inventory or materials you might need to buy for the project and not have to dip into your cash flow. Oh, I have a question in the chat. They're asking if it has to be a formal PO. Yes, unfortunately, and I know in a lot of cases there are people that will start projects with companies and they don't get a formal contract with the company. You either need them to sign the estimate that you provided them with to acknowledge that they are going ahead with the project, or you need to have a formal contract, or you need to have been issued a PO from the company for the project in order to take advantage of that funding. Now there's some other groups that have some interesting different flavors of funding. One is On Deck. They're a they're a bridge funder. Roynat, which is part of Scotiabank, which allows them to do big project funding. Innovia is another one that does sort of bridge funding, and there's many, many more. Capital Link, I forgot what the last one was. Anyways, and then I had already talked about the receivable payable management for loans. So before we go on, are there any questions so far? If you have questions, put them in the chat, and then I can look at them and see what you're asking. Okay, I think everyone's good right now. Okay, what would you do with the funding? When you're growing your business, there's lots of there's lots of perspectives and lots of things you have to think about. And often for business owners, it gets quite overwhelming. So one of the things that you might need to look for is somewhere to put your business. So you may want to lease a building, or you may want to buy a building. The next one that you might think about is, how do I train my team? What are the funding I can get to train my team? I need to build my team to be experts. Perhaps you need to hire team members so that you can grow your business. Maybe you're going from being a very small team of 1 or 2 to a very large team, and and maybe that is something you need to consider in 2019. The next one you might need to look at is websites and social media or marketing. And what is it that you need to have money for to grow your business in 2019? The next group that you might need to think about is money you need to grow your business. So that could come in any different size. That could be funding like we talked about for projects. It could be funding to get assets or build your team. It could be any number of things that are happening. And the next one is the the ability to buy equipment. So is there specialized equipment that you need for your business that funding might be able to help for? So of the people on the call, what kind of funding do you think you might need? And let's see it in the chat. So the chat in your windows it should be on the right-hand panel for those of you that just joined. I see some people wanted to, sorry, frog in my throat. A lot of people want equipment. So the way the equipment stuff works is the banks or the funding organizations will look at the equipment, and they'll want to know what you need, why you need the equipment, and what its value is. They're probably going to want the quotes for the equipment. And they're going to want to make sure the equipment is aligned with your business. So for example, as you can see in this picture, some of that looks like healthcare tools and equipment. If you're not a healthcare company and you're asking for that equipment, they're going to wonder why you want that equipment. So you need equipment aligned with your business. And a lot of companies will need things like furniture, which is also considered an asset to build a business. They may need technology, they may need computers, they may need equipment for their shops, they may need equipment for trucks. That all wraps into equipment. So when you're heading into 2019, make sure that you are looking at what type of equipment and things you need to grow your business. So next steps. And by the way, for anyone that jumped on late or anywhere, I am willing to share out the video. I will be putting it up on YouTube. We can share it out so that you can listen to it again later, should you need to. So next steps. So what do you need to do if you're going to go for funding? And a lot of people, this is where they get nervous because, oh my gosh, they have to figure out what it is that they need to do. But really, you don't have to do it alone, and you don't have to do it all at once. So first, you need to know what you're trying to do with the business. And if you don't know already, then book an appointment with someone like my team who can help you walk through a thought process and determine where you're trying to take the business, because you have to have a plan. You have to be able to go back and explain to someone that's going to give you money what you want the money for. In the past, I hear older business owners say all the time, well, I used to be able to walk into a bank and I used to just ask for $50,000 line of credit and they would give it to me. Well, they don't do that anymore. So you have to go in prepared with a plan, with a layout of what you need the funding for, and make sure that you're ready for the questions that they're going to have. The list of information that I showed earlier, you need to make sure that information is readily available. You have to make sure that you have all the information in front of you that the banks or the funding groups are looking for. You want to have a real business plan, not something that's on a napkin. I've seen some very interesting variations of what they thought was a business plan. Even if it's a short, abbreviated, or executive version of a business plan, it has to be well laid out and well thought of. And in there needs to be a list of what you want the funding for. 5 years of projections, 3 is the minimum, 5 is preferred, so that they can see that you are, in fact, on top of things. And review all the options you have available to you based on what you have been hearing, and then pick the ones you think you want to pursue. And you don't have to pursue them all at once. You can pursue one, and if that one works, then you can work on the next one, and etc., on and on and on. And then determine what it is you need the money for and how much you need, so that when you go to the bank or the funding group or the grant, you know exactly what you're looking for and how much you're looking for and what it's for. And the banks will also give you funding for operating, for cash flow management, but again, that will be based on how reliable and how solid you are on a credit basis. All right, so that's the end of the formal part of the funding. If you have any questions before we wrap it up, can you put them in the chat window and I will proceed to answer them. So one of the questions that I have is, how long does it take for some of the funding? Now that's a good question. The requirement for funding can vary. The BDC virtual loans are 4 to 5 days. Some of the private funders can probably fund in a week or so, but the risk is higher. Banks are typically a month or so to get funding through, unless it's a simple funding. And the grants can be anywhere from a month to 18 months, depending on the grant. One more question. So they're asking how they mitigate a problem on their credit report. So the problems on your credit report have to be mitigated through a combination of your bank and Equifax and TransUnion. Equifax and TransUnion are the main credit bureaus in Canada that the banks work with. You have to work with them in a combination with the bank that is associated with the credit issue that you're trying to deal with. And those credit issues can take up to 2 to 4 months to resolve. So we have to get on it if there is a credit problem. I don't see any other questions at this time. Okay, so I wanted to thank you for participating in the webinar. I will put the recording up on YouTube. I'm a couple behind, so bear with me. I'm just trying to catch up. And we'd like to, from my team to all of you, wish you a happy holiday, Merry Christmas, and a very prosperous 2019. If you want us to give you a hand, please reach out to us and we will be happy to sit down and help you with your business. And we look forward to working with you in 2019. Have a great day, everyone.